when we were building out, we didn't know how complicated this bank part would be. So we started building the product. We started talking to customers.
The number of failures that founders go through this journey is so much.
The fact was that it was the 100th conversation, so we had learned what they like and what they didn't like. But in 0 to 1 stage, you need a very different kind of persona. You don't write down these 4 values. Even if you write down, they make no sense. So I'd say underrated is definitely B2B.
How many people here want to build in fintech?
So I think so. We both went to college together. I mean, Shashank was a senior to me in college in IIT Roorkee, and so the journey essentially started because I couldn't get good enough rank to get into computer science. So Shashank was in computer science, and I always had a knack for coding. I used to love to code, and so there are a lot of folks in the college who love to code but didn't get into computer science, right? And generally those things are not correlated because it depends on the rank. So we formed a software group called SDS Labs where we used to get together and code software together, and it was a voluntary thing. We just do things because we enjoyed it, and that's where I got connected to Shashank. We used to spend a lot of time like writing code, creating software for use in campus, and it didn't really matter. It was just fun things to do. But we used to spend like almost like midnights and late nights just writing code and building stuff together. I think that's where we really gelled together and learned how to work with each other, create great services and products, and get some traction in the campus out of it. So when we graduated from college, Shashank got placed in Microsoft in Seattle. I got placed in Berger in India, actually in Middle East. And then while we both in our jobs we continued our culture where we both would keep chatting with each other over the weekends. Good thing about MNC jobs is that there is a lot of free time. So you are like free after 5 p.m. or something. Weekends are free. And both of us being techies, we didn't really have much to do. So we used to code. And for one of those, like we were building side projects, for one of those side projects, we were building a social crowdfunding platform, and we had to accept payments. And that's when we ran into the problem of how hard it is if you're building a side project, a startup or something, right? It was really complicated. While there were a lot of payment companies at that point of time, we felt that the whole process was not built for like upstarts. The process was built for large enterprises, because while there were a lot of volumes happening in India, most of those volumes used to come from large enterprises like an Airtel or an IRCTC. No, like startups were very early and small, and even the largest startup was Flipkart, which was a couple of $1 billion, but most of it was fairly small. So nobody really focused on that as a segment, and we felt that as an opportunity because payments is the bottom of the stack problem. Like you can't have social media and WhatsApp calling and video calling and all of those things without internet. You can't have commerce on internet without payments, right? So entire commerce, whether it's buying mutual funds online, to buying something on a Flipkart, to buying like social credits, game credits, whatever, any kind of commerce has to be enabled by payments. And so it felt to us that like if this startup ecosystem which was coming up at 2014 has to scale up, most of it would need commerce on the internet, and commerce on the internet would be built on top of payments. So that was the thesis of the idea. And because we were ignorant about fintech and its complexities, and we didn't have an idea of regulations and how to deal with all of that, we felt that this seems like an easy enough problem. I wonder why nobody's solving it, right? So we spent a lot of time talking to folks, talking to bankers. Everybody really discouraged us from getting into this space. The way we didn't understand why is everybody discouraging us. Right? So we started building a business plan. We started building a product, and we started talking to banks to get approvals and partner with them. And we faced a lot of challenges. I think the biggest challenge in the entire journey was these first 6 months getting a bank to say yes to two 24-year-old guys right out of college who don't understand anything about finance. The bankers would look at us and laugh at us and say like, hey, you have no idea on what you're getting into. There's fraud, there's regulation, there's so much compliances, and you have no idea on how to deal with all of those. And they were not wrong from their perspective, right? So it took us, I think I personally would have met at least 60 to 70 or maybe 100 bankers before we got the first banker to approve us and say that, hey, we'll be willing to partner. We need you to give a security deposit in case they get a lot of fraud, but we'll allow you to get started. And I remember that day because that's the day we got that approval, and the next day I left my job at Schlumberger. I told Shashank, like, leave your job in Microsoft. Let's come down and start building this. So that's exactly.
So I have to ask you, what was different about that conversation? The banker who actually said yes.
I think the fact was that it was the 100th conversation, so we had learned what they like and what they didn't like. So I think the first conversations we would I'll give you some advices, right? Like, and this is around the time we got into YC as well. So one of the first conversations I had with Sam Altman, who was heading YC at that point of time, was that hey, when we go to these bankers, they don't take us seriously because we are too young.
Yeah.
And his response was, then why don't you look old? And I said, what does that mean? And he said, like, wear a jacket, be unshaven, like buy a suit and all of those. So those all came in handy. We start wearing a jacket. I bought my first suit after that. Started wearing suits to these meetings, wearing a tie, keeping a little unshaved beard and all of those things to look a little old. So as I said, because it was a 100 conversation, we tried all of those things and reached to a point where we knew what to say and what to talk and how to look in all of these things.
Doesn't mean that you get funding when you wear a suit. That's not the lesson from this. But I think Harshil talked a lot of stuff, right? They started building way, way earlier, right? There's a power to building, and just building, you get a very different rapport with another person when you're building with someone. Two is, I think, a need that they themselves had, and I think they started to solve that, and that was a big part. Last but not the least, I think it requires an immense amount of energy and drive to actually have your 100th conversation. That means that, the 100th conversation is what's going to convert. If you don't have the 99, it's never going to happen. And a lot of people give up during that time. How shall I go back to your conversations with Shashank? Of course, this is someone that you knew. But even in the early days, you guys would have had to divide up responsibilities. Both of you were techies. How did you guys divide up, let's say, you doing more of a business role and or an outward-facing role and Shashank taking care of tech? What were those conversations like? And I'm sure there would have been disagreements, even as friends. How did you guys resolve that?
No, we disagreed a lot. We disagreed even today a lot, right? So that's the part of building together, right? So I think it just naturally happened. Like, we started, both of us were techies. We both of us used to code, and in the early days, I don't think there were clear boundaries. Like, I would take up whatever I could take up, and he would take up whatever he could take up. But I think from very early days, slowly we learned like what I like doing and what he likes doing. So I think Shashank is a hardcore techie, and he is very particular about the kind of architecture he wants, with the kind of design that he wants, and he's very particular about building things for the long term. So I mean, the easy example of that, I would code something, and next day I would see Shashank had rewritten all of it, and so I realized that this is something that only he should drive, because he's best suited at it. If somebody else writes that code and goes in the wrong architecture, he would not let it happen anyway. So I think very early, as things started scaling up, we realized that, okay, where do I fit in best and where does he fit in best? And I think we used to have a lot of conversations around it, that this is an area, who's going to pick this up, and a lot of times we tried and failed as well. So a lot of times I would pick up something, and as it scaled up, I realized that Shashank is better suited to handle that, and I'd pass it over to him. And same thing happened on the other side. But very quickly, it became evidently clear that I enjoyed the more front-facing roles, which is business side, sales side, meeting clients. Shashank loved the product and vision and direction that's set on the tech side, and he wanted to ensure that goes on the right way and more long-term focused. I think that's how it happened. While that is a broad boundaries, even today they're not very strict boundaries in these things. So a lot of times in sales conversations, Shashank would go in and step in, feels that something should be done differently, and I would go and step in some product direction that should be differently. But I think what we have to now is that it's very clear that who has the final word on what. Right, so I have the final word on the business side of things and decisions taken on that side. He has the final word on tech and product side of things. I think that clarity is important. Otherwise, I think we keep stepping on other charters. So the charters are not very clear, but the final word is clear.
Fair enough. Now, one is to have this communication and protocol between you and Shashank, and another is to figure out as to what's the kind of people that you will recruit very early on. If you had to pick one or two things that you would look for in your early recruits that actually set the tone for the culture of Razorpay, what were those? And if you had a set of culture or values right in day one, what has changed between now and when you are a much bigger company today?
Yeah, so I think I think we've been very lucky in the sense that we found a really good set of early folks, a lot of those who still continue to be at Razorpay today, that really defined and helped us define and shape the culture of Razorpay. And if I were to break it down in terms of most successful folks in the early days, are the ones who were journalists, who really cared about the kind of organization that's getting built, and who are like really just like, I would say, like just missionaries, like just going towards this mission that, hey, we want to build this out. We don't know how it's going to get done, but we're going to figure it out. And are generally journalists and created 0 to 1. The kind of hires that didn't work for us in the early days are the specialist kind of hires, where we tried to find a really great like head of sales who has had 15 years of experience and really good at his large company that he was doing sales at, and tried to building him a 0 to 1 setup, and it totally failed. Now those are the people we hire today. But in 0 to 1 stage, you need a very different kind of persona. And what we learned is that persona doesn't fit well at 10 to 100 as well. So the early stage folks that we had and were journalists worked really great to a point of time. And at some point of time, the specialist made more sense for that business because as we started hitting that scale up journey from 10 to 100, we needed those. So we kept finding these, as I said, some of these journalists and early stage folks are still with Razorpay. The way that worked is that we have a lot of newer things that Razorpay keeps picking up, and we put these people on those kind of charters. So, for example, we launched Razorpay X, we launched Razorpay Capital, we are doing Razorpay Pause. A lot of these newer 0 to 1 stages, we'll put those early folks in because they fit better here. And as a business hits a scale where it's hitting that growth phase where it needs to scale from 10 to 100, we'll have specialists who are good at that role in particular.
Is there a specific value that has stayed from day one till today? And maybe a specific value that has completely undergone a sea change?
Yeah, so I think most of the values have stayed true. For example, one of the values that we have is transparency. Now, how transparency is implemented has changed over the years, but core values have stayed the same. So what that means is that even if you are in a sales domain, you have access to what's happening on the product side of things at Razorpay. If you're in product, you have access to what's happening on the sales side of things at Razorpay. And generally, there's an open ecosystem in terms of the direction that your company is taking, the vision that we are taking, the specific product initiatives that we are going to launch. Generally, people internally have very strong beliefs. So if you talk to anyone at Razorpay, the first value that they typically say about our culture is transparency. That there's generally very openness and information available within the company. The value that has changed a lot. In early days, we used to have a value called stay lean, which is where we wanted to be like we came from YC, so we looked at a valley culture, asset culture, and where large companies would get built with 10 employees, 50 employees, and we wanted to replicate that. But what we realized as the company scaled up is that honestly, like we all want to replicate that, but honestly, in a country like India, it's actually sometimes cheaper and more efficient to have more people doing their job than using a software tool, right? Like we would look at software tools which cost $7 an employee a month, and I would compare that to hiring one accountant to do that, and it would just not make sense. So that's a value that got fizzled over time in some way. I mean, we are today a 3,000 people company. But the core tenet of that is stay there that we try to minimize the amount of manual effort that we have to do. So the purpose of that value was to reduce manual effort, reduce manual interactions. But the purpose of reducing manual interactions is not from cost perspective. It is more in terms of efficiency, that can it be scalable. So things where scalability is not needed, sometimes it's okay to have manual things.
My two last questions before we get into the fintech domain. Any specific VC conversation that you still remember, yes or no? And how did you decide? And maybe it was obvious. There's a bunch of founders here who maybe go after something they're passionate, but maybe the VC route is not their way. And whether that was YC or whether that was later stage investors, how did you get yourself ready for it, or how did you know that was the path?
Yeah, I mean, I remember every VC conversation for that matter, but I think there are very interesting things, and I'll say both pros and some good conversations and some bad ones, right? So first of all, I think in very certain early days that payments is a scale business, right? Like, so payments is always a very thin margin business. There's no $100 million payment company that's profitable. Like it's impossible because the margin is that low. So payments needs rapid scale, and that means funding. So for us, VC was not an option. Like we had to take VC funding. There's no path for us to scale up to, let's say, $10 million of GMV and be profitable because the margin would be that thin that we couldn't make that money. So we need to have billions of dollars of money flowing in, and only then we start making money, which means that we need VC funding to get to that scale. And I think for most founders, sometimes that clarity is missing. That like I speak to a lot of founders where you can hit profitability very early, but then you take VC funding and you're forced to scale up that fast. So I think that is an important decision-making factor. That what kind of scale do you need to reach profitability, and how big can that scale be, right? If you can't give a VC like 10x, 100x returns, then there's no point of taking that money in. For us, I think we had a lot of VCs over the years, but I think one or two conversations that stood out is like in early days when we were scaling on the payment business, we took money from a lot of large VCs, and without naming them, like one of the largest VCs in India at that point of time. And we took like, I think about $11 million when we were at almost zero revenue. And so when we started scaling up, we used to burn very low amount of money. In fact, because we are B2B, there was no way for us to give cashbacks and rewards and burn money quickly. So our burn was extremely low. It was low to a point that at some point of time we turned profitable because we were earning more on our bank interest than we were spending. And I remember meeting this VC in one of the coffee conversations, and he said that you're the least burning money in our portfolio. And he meant it as a negative thing, right? Like that. So today's conversations are different, but this is, of course, the zero interest rate peak of that. So the push we got that, hey, you need to start burning more. You need to spend a lot more money. You need to find a way to scale. And we kept pushing back that this is not a B2C business. There's no way that I spend, like if I give a merchant discount today, it's not like I'm going to do 20 things tomorrow and make money from it, right? Like if my price goes down, it goes down and it stays there, right? The price always goes down only. There's no way it goes up. So I had to push back a lot on those, and it was not just 1 month, like it was for 6, 8, 10 months. We kept pushing because our graph was scaling up, but like our graph was scaling up from $200,000 of GMV to $400,000 of GMV. It's doubled up, but from a large VC's perspective, this was still zero. So through the year, we kept pushing back, and we kept pushing back that, hey, we are building the product right now. We're getting to, like, we need a certain scale of product before we can start getting these large clients to jump, which got step jump, like getting clients like Flipkart or Swiggy or Ola and those clients. And that needed us to like spend 1 year just building. And that was a lot of hard conversations. But I think after a point of time, we got that traction, and then we started we were able to onboard larger merchants. And then we saw that hockey stick curve. But it took almost a year and a half to start seeing that. And those were some of those hard conversations. I think the challenge that, and I sympathize with a lot of those folks, but the challenge is that the B2B and B2C mindset is very different, and very few investors actually understand B2B as I've seen it. Because most investors invest a lot in B2C and they've done 1-2 B2B bets. Of course, that has changed now with SaaS and other things scaling up. But in B2B, the kind of scale up that's needed is very organic and is driven a lot by product versus driven by marketing and spend and like just pushing offers out. And that takes its time to build out. Like I can't scale my product 100x by throwing money at it. Like I need to hire engineers, hire product managers, they need to write specs, they need to deliver that, test it out. Like there's no way to fast track this journey, no matter how much money you have.
My last question on this is one of the things that Sam Altman himself talks is the number of failures that founders go through this journey is so much, right? Only the big hits are out there, the obvious failures are out there, but every day there is some heartburn. You know, someone you wanted has not joined, some VC has rejected you. What is your mode to handle failures, and has that changed over time? Maybe at the start, when you were just a team of 10, you used a particular way, and today it's different.
Yeah, see, the biggest failure, as I said, was in the start itself, right? Like getting through that, because we had no way to counter that failure. As you start scaling up, you have some positive signals that counter that failure, right? So you have customers who like you customers who love you have some employees who love you have some investors at least who are willing to invest in you. So you have some proof points that keep you going. And I think that as the company starts scaling up, those proof points become the source of energy that, okay, like if you go to a VC meeting and they don't like you and they don't want to invest, it's fine. You go back to and speak to 10 customers and some of them say, hey, we really love you. That gives you that energy. And I think that has become the way to deal with like rejections over the years. And that's why like one of the principles that I follow is I speak to at least one customer every week. And that does two things for me. First is give me a real test of whatever discussions and strategies and plans that we're making up in the office. Like it helps me validate and test those directly. And that's again an advantage of being in B2B, that I can directly speak to our customers face to face and test the hypothesis that we are forming in our office, right? The second advantage it has is what to your point, like it gives a lot of positive energy when you understand a problem that the customer is facing, how you are solving the problem or how you could solve another problem that the customer has. And that goes a long way in solving these challenges of rejections. You know, I think you're right that every point of this journey has a lot of rejections, right? Like right from us starting to investors. Like I think before we went to YC, we spoke to a lot of investors. Nobody was interested because they said there are 20 payment companies. Why are you building the 21st, right? And after we got into YC and got the traction, then those conversations changed. Similar on employees, right? Like I know Shashank used to hire engineers in the early days, and there are some engineers that he has pinged for almost a year, and his LinkedIn is like, hey, are you interested? And hey, are you interested? Almost every couple of months. And it took him almost a year sometimes to hire those engineers. So it takes a lot of effort to get all of those things. Right? The baseline is that I think growth changes all of these things. So growth is the answer to investor rejections, employee rejections, anything of that sort. Because as you keep growing, these conversations keep going back and changing around, right? I think the bottom line is that growth trumps everything. So as long as you can find a way to grow and grow into the next scale that you need to be, the same people who have rejected you would come back and allow you to do things. I named like how almost 100 bankers rejected us at that point of time. Today, almost every banker wants to partner with us and wants to do a lot more with us, right? So we have to say no a lot of times because we don't have bandwidth to do that, and those things change because of growth.
the older I get, and as a student of startups, I think I just have two definitions of entrepreneurship now, and I think your conversation, your comments kind of hit both of those. I think entrepreneurs are essentially people who jump off a cliff and build a plane on the way down. And I think I first saw your LinkedIn's, both you and Shashank. I was stunned by the fact because no other fintech founder I know started without having spent some time in the financial services somewhere. Because you're told as a regulator, you need to be older to talk to regulators, multiple stakeholders, blah, blah. So that's one. The second is, I think entrepreneurs are just people who can keep going even though they get slapped every day. That's it. I think it's very, very hard, superhuman, but clearly you guys have done that. How many people here want to build in fintech? Okay, so about fifth or sixth. So I'm not going to go so specific because we want to sort of draw out some other lessons broadly. I think if you were to look back, lots of other payment companies in B2B and B2C, why do you think you guys have reached this scale and you're worth what, 7.5 billion, and so many other people have not? Like, do you look back and think there was something different about your approach that the competition didn't do?
Yeah, anything that I say will be with survivorship bias. So take
That's
it
true.
with that.
That's true.
But I think one thing that we had for us is, and goes back to some basic questions that you were saying, right? Like we were very, very particular on the kind of customer base we wanted to build for, and we stuck true to that through the years. So we were very clear from day one that we were building for this merchant, this business who wants to sell online, and we want to stay true to that. So till date, Razorpay has no B2C product, and we have stayed through that, even though there have been enough pushes from investors and other people in the stakeholder. Hey, why don't, like, when wallet was a silver season, like, why don't you launch a wallet and get your valuation to grow from this X to 10x? Why don't you launch a UPI app, and UPI was suddenly scaling up and your valuation grow up? And why don't you launch BNPL and get 2 years back when everyone was doing BNPL? So then there are a lot of these fads. And again, there's nothing wrong in building a wallet, or nothing wrong in building a UPI, but building it because somebody's saying that, hey, it's the exciting space to be in, I think that's always the wrong reason to do that. And I think a lot of companies went around those directions that, hey, let's go into this because this is the most interesting thing today.
Yeah.
And I think what worked for us, so we faced a lot of impact on that short term. The short term, you'll see a company like who has nothing in terms of scale compared to what we were doing, or product depth compared to what we were doing, getting far more valuation because they had a wallet offering as well. But long term, I think this approach worked out for us because the strength that we built on this B2B side was unmatched. So today, the kind of strength we have on the merchant ecosystem is much more deeper than all the other companies that try to do too many things at once. Simply because that we were very focused on this work customer base, we were able to go and promise to that customer base, hey, we are building for you and only you, and like everyone else is trying 100 other things.
So we're very clear that B2B, but also within that, people, you wanted to benefit from internet growth.
That part got brought
E-commerce
in over time.
and
We started with focusing on just like startups and people selling online. Over time, we brought in ourselves to do startups, enterprises, and mid-market. And then today, we power the largest merchants as well in India. Like we power the Airtels of the world, we power the Googles and Facebooks and all those. So that part got broadened, but the core customer persona remained the same. That somebody selling online or somebody building on an online business.
How obsessed were you with some mental model of what you would consider PMF? Like, how did you define it? How did you start talking to users? How was that experience?
Yeah, so PMF in B2B space is very hard as a journey to figure it out. The challenge in PMF is that you have a sales team, and a lot of times, so typically people define PMF by traction you get, but sometimes it's easy to obfuscate traction in a B2B space. If you're a very strong hustler in your sales team, you can get PMF quickly because they might be able to find a way to sell to 10, like if you define 10 clients, then they can find a way to sell to 10 clients, even sometimes missell them. So it's really hard to figure that out. I think for us, it took us almost three and a half years to actually hit proper PMF. Before that, it was sales PMF. Sales PMF came early. That came up in the first 1.5 years of operation because it was B2B. So you got a decent sales team which was able to target and close customers. There were enough gaps in the 10, 15 companies that existed that the sales team was able to figure out how to get sales done. There was no repeatability to it. There was no way to predict how it is. So the 3 or 4 components that you need for PMF and repeatability and predictability didn't exist. But we were able to scale from number to number. We were able to get a decent 15-20% month-over-month growth. And that's what I call sales PMF. The true product PMF came about 3.5 years later, where we started getting enough organic traction that people would just come and sign up and go live without us talking to them, and that happened at a scale where that we were not able to manage. So we were getting a lot more inbound leads and customers coming in that our sales funnels, our support funnels, and other things were able to manage. And that's what I called like true PMF, where a product actually has like it is a proper product market fit and not just a sales market.
It's a great point actually to differentiate the two.
In B2B, it's sometimes obfuscated. In consumer, it's certainly very clear that it is a product market fit, or you can sometimes have a discount market fit where you get great cashback or discount that it strives. But in B2B, the challenge is sales market fit versus product market fit.
And I mean, we try not to talk about founders thinking about what will get funded, and clearly that's not what you did, and times were different. But when you said you did 11 million before revenue, so what was proven at that point?
Yeah, so that is hard for me to answer honestly, but I'll say that. So this was a very interesting VC investment that happened. Honestly, we were right out of YC. We raised $2.5 million out of YC. We had gotten the payment license. We got our first few customers, and the reason we got the $2.5 million and YC got into YC was because the hardest step of building the payment business in India, which was getting the bank approval and getting the few first customers. So for different businesses, there are different hardest steps. For our kind of business, the hardest step is getting those two things aligned, because there were very few, or to your point, like there were no tech founders who had gone to that point even by then. So our ability to go back to place and say, hey, we are the only tech founders building in this space and have gotten the bank partnerships aligned. We have got the first few customers aligned, and we can scale up because nobody else is building from a tech product mindset. So the reason we'll win in this space is because we are building from a tech product mindset, which is needed to succeed in payments, and nobody else is building from that mindset. So like you said, like most people had built payment companies at that point of time, and even today came from a finance mindset, was actually our advantage, because they came from a banking and finance mindset. The kind of experiences, the product experiences, the customer experiences they had built were very different than what is needed in today's day and age, and that's something that we were able to bring on the table. And that's another reason that we were far more successful, is because we were able to solve every problem from a product lens versus solving it from a finance lens of the way a bank does it.
Yeah. I mean, Stripe hasn't been able to sort of grow in India for multiple reasons and all. But I'm curious, like you have some other company that I'm sure you also look up to in terms of some things they've done. What was an interesting learning from something like Stripe? And how did you localize it to India?
Yeah, so I think Stripe was honestly a strong inspiration for us to start, right? Like we would look at, like when we were doing this, when we were building this side project and wanted to get access to payments, we looked at Stripe, we looked at Braintree, we looked at those companies in US, and we said, hey, why doesn't something like that exist in India? I think that was honestly the starting point. In the early days, like of course, a lot of things we were trying to replicate at, hey, how does Braintree solve this, and how does like Adyen solve this, and how can we have something like this in India? But as we scaled up, we realized, like, of course, India is quite different. So, for example, one of the strong positions Stripe had was developer friendliness, and they just did that. A self-serve developer platform was essentially what Stripe is today as well, is a self-serve developer platform.
Correct.
When we had that from day one, that works well for small
numbers.
Startups in India. It doesn't work well for mid-size or large enterprises, because the decision makers sometimes are product managers, sometimes finance folks, and need to start customizing specifically channels for them. So that was a learning for us.
And that adds headcount also, right?
Yeah, that adds a headcount, and kind of conversations you need, the kind of like the marketing you need and branding you need is a little bit different. So while we had that going for the unregistered, or as we call like the influencer category, of people selling on Instagram or people selling on Facebook, but for somebody like if you were to try to sell to a Swiggy or even a smaller Swiggy, like a $10 million Swiggy, then we need to be able to market ourselves to product managers and finance folks, and that's why it needed a little bit change in approach. So that's something that we learned along the way, that India is different in that as the company scales up a little bit bigger. For example, we have conversations with US companies like Facebook and Google, where even at their scale, the decision makers are actually engineers. The engineering manager in Google decides which payment platform will go in. Hard to do that.
Doesn't happen here.
Yeah, doesn't happen. Even in a company like Swiggy or a Flipkart, the engineer would not be the one deciding. It will generally be a product manager, or in some old school companies, it will be a finance guy. So then you need to learn that and adapt to that ecosystem, and that's what we had to do as we scaled up.
So what was the point at which you started to say, okay, you need to go beyond, you need to do Razorpay X and a broader product beyond just a payment gateway?
Yeah, so again, like speaking to customers was the driving factor on that. So we kept speaking to customers, and we scaled up. Like we would always go to our customers and say, hey, what else can we solve for you? What what are the other problems that we face? What are the core problems we face? Because initially it was just payments. There's so many problems. So we started with payment gateway, then we launched payment links and payment pages and invoices and so many things. Because they said, hey, I want to accept payment from my customers and I want to send a link. I really don't want to come to my website. How do I do that? And all of those things came up from there. As we scaled up further the payments, a lot of these folks would say that, hey, while you're solving payments for us, there's only one part of my problem. The money comes in through your amazing platform and everything. But after that, I have to spend a lot of time, effort, energy to distribute it to, let's say, my delivery partners, to my suppliers, to my vendors, and so on. Can you solve something there? And that's when Razorpay came along. So it started as a payouts platform. So we built it for marketplaces to distribute money to vendors, for gig platforms to distribute money to gig workers. And it started from there. And then it slowly scaled up to covering the whole aspect of financial flows for businesses. So as we scaled up on that, one of the biggest dispersals for a business was payroll. So we acquired a small company and integrated into the Razorpay platform. And today we are the fastest scaling payroll platform in India, simply because there's nobody building payroll from a tech lens where you can do simple. I think a lot of these challenges also came from our own experience. So in the early days of Razorpay, I remember on the 31st of every month, I had to keep my laptop with me because STFC and a couple of these banks don't allow anyone else to approve the payment except for the one laptop that is authorized to do it, right? And that felt like completely stupid to me. And some of these ideas like payroll and stuff came because they realized that, hey, there's no single platform today where if I put in that, hey, I want to pay somebody 12 lakh rupees of salary, some calculate the TDS for it, PF for it, ESI for it, PT for it, and do it with one single click. There's nothing that existed. So those are the ideas that came in, and we speak to customers. We felt that, yeah, they resonate with the same problems, and we can add those. So that's how Razorpay came into being. The Razorpay Capital came into being because the biggest problem for every small business in India is getting access to credit. And it's today, even today, an unsolved problem. I don't think we have even solved it fully. It's such a deep problem that it will take a lot of years or maybe like 5-7 years to actually fully solve it. But that's how each of these problems came to be like in our roadmap. But we are also very clear that just because the customer is asking everything doesn't mean we build everything. So there's a fine line between that you keep asking customers what more do you need, but you also have a vision. And if anything that they ask aligns to that vision, then you build it.
So good segue into, you mentioned the word credit. And so good segue into, let's take a step away from just Razorpay and broader fintech. Is lending a feature, or does every fintech company eventually have to become a lending company?
I'll put it this way. I think credit is the deepest problem in India. It's the most unsolved problem in India. It also has the highest margins, right? But the highest margins work out only if you know how to do collections well. So
it's a good summary. I think the last two sentences are a pretty good summary of.
So it sounds high margin when you don't account for collections, but it takes a lot of effort to get there. The challenge that exists when people try to build the entire business model around lending, I don't think I agree with that. I think you need to have a core business model that works, and then you can add lending on top of it, like to scale it further. And that's what we are trying to do. So our core business doesn't rely on lending to scale. Our business will be profitable by itself. Like our payment business is profitable today. Our entire business can be profitable by itself without getting into lending. But we need to get into lending because it solves a customer problem that only we can solve, and it generates margins. But the primary reason for us to get into lending, the primary reason to get into any business for that matter, is not because it's high margin business. It's because that it is a problem that is unsolved. I think that's true for credit, but only if it's done in a certain way. There are 10,000 or maybe more NBFCs in India. There's no limit on number of, I think if you look at RBI website, there's so many NBFCs. So everybody is giving credit and they still don't have enough, they're still not able to make money. Right? So there's no dearth of pure player lenders in the country. There are enough lenders. And that's why when you talk about FLTGs and co-lending, that's exciting because there's so many lenders who are sitting on cash, they just don't know who to lend. And so if you can marry that with a platform that works and that scaling up well, it can be a great outcome. But only if the business model is sustainable by itself. I feel that pure lending business models can work for very few companies, and those will be like new age lenders and new age NBFCs. But it's a very limited market.
I also think if you don't have something on top, like you're building on top of your base and the data you have, and you're part of the customer workflows, it's almost very hard to differentiate because everybody's cost of collection, servicing, and acquisition ends up being in a very narrow range. How much time do we have?
We have one more question from you.
Okay. So one more question. Now we could spend an hour breaking down fintech in lending, payments, lending, insurance, investing. Uh, what else? SMB. I mean specifically B2B layers in this. Since I only have one question, what is overrated? What is underrated? I know that's it's specifically like within these areas, like not.
So I'd
just
say
at a high level.
underrated is definitely B2B. I think there's so much, and it's changing. There are a lot more companies that I speak to now which are coming into SaaS in particular. I think has taken off a lot in India and it's growing a lot. But I think B2B in general is a broad category. When I speak to businesses, and as I said, I speak to businesses very frequently. There's so many problems that they have, and the great part about building a business is they're willing to pay. They understand the value you bring in, and even if you like, if we say term Marwadi businessman in India, even if you talk to a Marwadi businessman, if you add a value to him, they're willing to pay you. And they actually want to pay you so that you can sustain and build that value for them. So that's a great aspect of building for B2B. But because of all the limelight and everything that's captured on the B2B side, I think there are not enough startup founders building for B2B in India. I think that needs to change, whether it's on the fintech side or even on the general B2B. Like we talk to so many businesses, there's so many inefficiencies, so many problems that every business is solving. Like payments is something that like every business is trying to solve their own payments problem before we came into picture, and there's no point of it. If you're building a clothing brand, why do you have 100 people payments company? Payments team inside you. If you talk to like a Flipkart, you have to 500 people payments company inside you, which is larger than most payment companies. So if you're building a food delivery company or building an e-commerce company, why are you building a payments company within you? And the reason they had to do that is because there's nobody who's building a top-notch experience that they can't build themselves. So you centralize it and you can create like an excellence within one company around it. You can go and serve the entire ecosystem. We did that for payments. I think that same applies for B2B payments. The same applies for accounting. Same applies for invoicing. And this is just the finance side of things. There's so many non-finance problems that every business has to solve for, and they're doing it themselves because nobody has really built excellence across the ecosystem on it. And
what's overrated?
Overrated, I'll go back to credit, right? I think credit is looked at like this amazing pot of gold that everyone wants to get into. That hey, once we get credit, we'll just win. I believe that credit is definitely the biggest need that most businesses or most consumers also have in India. But there are enough credit companies that are trying to solve it. The reason, and if you study hard enough, the only reason they are not able to solve for it is not because of lack of capital or lack of just underwriting process, but lack of enough information, lack of enough data, lack of enough platforms that can connect credit back to the credit givers. I think that's where the actual need is, rather than having one more lending company out there.
Super. Before we open up for questions, is there, since now you're 8-9 years into it, I'm sure you are also mentoring some new fintech startups. Is there anything that you think is a pattern you see a lot of founders getting started in fintech still make one common mistake? Is there anything you see, or is there too much fear of regulation?
I want to add one question to that, which is, what do you see in founders whom you invest via Marshots?
Yeah, so from Ashur, I typically invest in non-fintech because fintech generally ends up being some sort of conflict, so I avoid it. But in fintech, I think, but I still speak to a lot of fintech founders, and one of the biggest challenges I've seen, I think, is they feel that hey, they can hide from regulation. A lot of founders feel in the fintech space that hey, if we build in this, we are too small, nobody's notice us and stuff, and that might be true for small scale, but no founder is building to stay small, right? And I think almost every founder is building to scale up big. And if you look at most of the fintech fiascos that have happened in the last 2-3 years, that have happened because fintech companies or founders expected that because they're small, it's okay to hide away, and they suddenly scale too big, and the regulators had to clamp down on that. So I think it's just easier to start assuming that the regulators will see you, when will notice you, when will question this. So build assuming that that's going to happen someday, and because you're not building to stay small anyway. So if it's not going to scale to that point, then anyways, what's the outcome of building this? I mean, it's going to reach that point someday. Then be prepared for it from day one.
Shall we take questions? Can somebody carry the mic, Sankalp, or?
Thanks, Harshil. First of all, thank you for building Razorpay. Any of us who've dealt with CC Avenue in the past prayed for disruption back then. So thank you. My question is, you talked about regulator overreach, right? Razorpay was also a victim recently. Curious, how did you manage company morale during that time when sort of new onboarding was stopped?
Yeah. No, so it was a hard problem, honestly. And the hard problem about this is like you have challenges through the company where sometimes your competition is doing better and stuff like that. The easier part of those challenges is that you're able to give a response on what you're going to do or what is going to happen. The challenge with the regulators is that you don't know. Sometimes as founders, you also don't know how long it's going to take. What is the actual resolution? Like, we have done something from our side and submitted. Is that enough? Is that not? We'll hear. So the challenge of with regulatory uncertainty is I treat regulators like market. Like, you can't control the market, you can't control regulators, right? So the market forces change suddenly, and what you do if you're caught on the wrong side, right? So the same thing is with regulators, right? Sometimes the regulations change. If you're caught on the wrong side, you have to adopt, you have to change, you have to satisfy, and then you can move along. And for that year, I think the only thing that the 2-3 things that work for us is that because we had to provide enough product gambit, a lot of those were unimpacted. So you could continue to scale up on that. We had offline, we had Razorpay, we had international, we had POS. All of these were continuing to scale up. So we were able to change priorities and deploy resources into things that we continue to scale. We were still allowed to scale on our existing customers. So we were able to cross-sell and resell more to them. So there were enough opportunities outside new onboarding that we were able to focus on. The second thing that worked is that we were generally very transparent with people on what's happening. So people would ask, hey, what's next? And say, hey, we have met the regulator, we submitted the response file, and we're awaiting that. And usually be very transparent because there's nothing much to hide, because there's nothing much that you also know in regulatory conversations. You have limited information, but that limited information was generally very clearly available to people within the company. I think that gives, if nothing else, gives a sense of trust that, hey, whatever is happening, we are in the loop of, so suddenly something will not change. I think those are the 2 things that kept us going.
Let's take one. Anushrut.
So Harshil, firstly, thanks a lot for that session. Truly, truly insightful. So my question is, if for the first 10 to 15 hires, what are few signals or traits do you look for? And what are some signals or traits you should avoid, especially for the first 10 to 15 employees?
Yeah, so 2-3 things. I think the first thing that you're looking for is that journalists, people who are willing to do anything to make the company successful, right? Like, they will not come with saying, hey, I'm a sales guy and I'll only do sales. The people who will come in and say, hey, I'm coming in because I want to be part of this journey, and I'll do anything that comes my way. So most of the early guys that we had, like, they would do, like, for example, we didn't have any sales hire. We had 3 business hires that we had in the company who do everything to do with non-tech. So that means marketing, sales. If a legal agreement came in, they'll review legal agreement. If they have to go out and meet customers, they'll do that. If there's a partnership that has to be struck, they'll go out and do that. Like, there's no defined boundaries in that role, and people were comfortable with that. I think that's one thing that's very important in the early days. The second thing is like a core focus on building the right kind of company and culture. So culture fit is extremely important. I mean, it's always important, but it's extremely important in the early guys, because the early folks in the company will not just set culture today. They are the ones that are going to set culture for years to come, because whenever new folks get hired, even today, they'll first look at these early guys and what they do, and they'll replicate that. Or if they are doing something which is not in the culture, they'll say, hey, this guy has been for 5 years and he does things differently. Why should I try to do right by what the culture says? So that piece being second. I think to the while there are a lot of aspects I can cover, the third most important aspect was a heavy degree of trust between the early team is important. And that requires, because in the early days, you're working long hours together. You don't have a lot of hopes, because there's not a lot of business that's scaled up. After a point of time, of course, your business, you've raised funding, you've scaled up, there's media attention, everything. So it's easy to keep the morale high. But in the early days, like, the thing that works for morale is that the camaraderie within the team, where everybody feels that, hey, we are all suffering together, but we're all building together, and we'll all if we go big, we'll go big together, right? I think that camaraderie is really important. So any sort of while it shouldn't happen, but any sort of you get somebody who's even a little bit political or trying to push things in a different way and stuff, that doesn't work at all. And you have to be very on your toes for it. Even a slight hint of that needs to be taken strongly. I mean, it has to be done at every stage of the company. Early days becomes really, really important. To things that don't work, I think one of the things that I said earlier that doesn't work is some of the very successful people in large organizations don't work well in 0 to 1. And it's nothing to do with them. It's the things that make them successful in large organizations doesn't apply to small organizations. The things that make them successful is extremely structured work, extremely driven by numbers, extremely being able to command the brand and leverage the brand that they have and go out and sell. So we would hire somebody from an ICICI bank, but that guy didn't know how to sell without an ICICI bank brand standing behind him, right? So the things that made them successful and extremely successful in the large scale environment doesn't work well for small scale, and you need to be very cognizant of that. A lot of founders just do that mistake. We did that mistake, but it's important to understand about that. Doesn't mean that nobody from large organizations work. The kind of people that were successful or that we hired from large organizations were people who were very unhappy in their large organizations. So these are not the most successful people in their organization. So those are the kind of people who can work at early hours, but typically it is not the large organization guys that will lead to your success.
Thank you. Thank you.
Was the organization better because of them, or were they better because of the organization? Let's take someone towards the back.
The question that I had was, how did you think about your roadmap in the early stages, especially in the early stages where it's fairly uncertain what the product is going to be, and you're constantly iterating, trying to understand your customers and figure out what to build. So how did you think about roadmap in the early stages of your journey at Razorpay?
Yeah. It's a hard problem, especially in a B2B environment, and I'll give a little bit of context. In B2B environment, it's easy to become a services company very easily because when you go to your large customers, everyone has their custom demands. Hey, build this feature, build that feature, and you keep building those, and that can completely control and own your roadmap. So we had to really, it started happening to us very early as well, and we took a call that, hey, we'll segregate 20-30% bandwidth specifically to build long-term things, because otherwise we'll keep building things which help us make the next sale happen. And so I think that was the first principle, that having some dedicated bandwidth for long-term things. Like, for example, we wanted to build self-serve onboarding, right? That no B2B client needed that, but we needed it to scale rapidly on the organic side. So we created dedicated bandwidth for that. We similarly created dedicated bandwidth for things that we wanted to build on the marketing and SEO side. Again, no B2B client would need that, but we need to do that if we want to scale long-term on the organic side. But on the core enterprise and mid-market side, I think we did build what the customers wanted from us, but we always would build with a commitment that, hey, find a customer who's committing to sign up if we build this, and then we'll go out and build. So this was a typical enterprise sales process where you build a feature because you have a commitment from client. The only difference that a product company needs to have versus a service company is that whatever custom features you are building, show that you build it in a way that it's scalable for the entire base and not just for a particular customer. So we never built a feature which would work only for that particular customer. Generally, we try to find a why do they need this feature, and then try to find something that we can build at the product level that works at the platform level and would work for hundreds of such customers versus one such customer. I think it's a hard boundary to.
Did you lose business because of that? Did you say no to?
A lot of times, like for example, a lot of government clients would ask us that, hey, if there was a port authority that asked us, hey, why don't you build the entire port management platform for us, right? And they were willing to pay money for it. They were willing to pay crores of money, which would make economical sense, but we would be distracted. Like in the early days, the most important resource you have is bandwidth. And if you were waiting 50% of bandwidth, even if they are paying for it, I couldn't buy additional bandwidth easily, right? I couldn't suddenly get 100 more engineers and give 20 engineers to building this out. That's the most precious resource you have, and you have to assign it very carefully. So we refused that client and we lost that.
We do see this sometimes. It's very hard to resist, but maybe this side down.
Hi.
Just trying to be fair.
Yes, hi. You talked about the sales market fit. Do you think the founders should do the initial sales before you have a PMF, or should you hire a salesperson and then
I don't think there is anything wrong with hiring a salesperson, but the founders absolutely in a B2B environment need to do sales. There is no question about it. And every founder, for that matter, you can't say I'm a tech founder, so I'm not going to do sales. Because in a B2B product, again, different from B2C. In a B2B product, it's very hard for a B2C environment. I can guess what an average customer needs. In a B2B environment, it's very hard to get what an average customer needs, because your engineer has never been a buyer on the other side. So your engineer can probably think, okay, what kind of wallet type is needed, but he can't think what type of payment gateway is needed, because he has never been a payment gateway buyer on the other side. So it's important for in the early, not in the early stage, even at most stages, even today we do sales. So for a B2B founder, it's important to be part of the sales process very early and probably forever. It's of course that you have a dedicated sales team that starts doing most of the groundwork over time. So today, of course, I'm not doing out and doing the sales. The sales is mostly done, but I'm still going out and meeting these customers and trying to close or get the final okay on the deals that happen. But it's important to have that touch, because that's the only way to know what the market needs. In a B2C environment, you can probably guess it yourself, or you can be a consumer yourself.
Beautiful, thank you.
Are we, Karan?
Yeah, one last.
Oh, one last question. Okay, you pick your favorite.
So what went behind the name Razorpay?
Oh yeah, sorry, you had asked this question. I missed that. So initially, of course, we are building a payments company, and we're trying to. It's not a very exciting answer, honestly. We are trying to put the name Pay with something, and we were very certain that we wanted to name Pay in it, so that it's obvious that we are a payments company. So we tried multiple iterations, we tried, I think, Alpha Pay and whatnot. We're trying multiple names. with pay and see what fits. I think Razorpay just came up as a suggestion from one of the folks.
Was he shaving?
Maybe, probably. But I did ask him, but that suggestion came in and it just hit everyone because the mental image when somebody said Razorpay sounded like something cutting edge, something sleek, and something very definite. And I think those things applied for us. The other reason we did that was also to separate from the crowd. So most banking or financial apps, if you look at, have very geometrical logos and green-ish colors, simply because green is the color of money and geometrical logos give you trust. So like HDFC Bank will have a square logo, ICC will have a circular logo, and SBI will have a circular logo, and so on, because they give a feeling of trust. So we were very clear on it that, hey, if you're going to fight the trust battle, we're never going to win against the banks, right? Like we can't say that, hey, we are more trustworthy than SBI, right? But we can say we are more cutting edge than SBI. So the logo needs to reflect that, and the mental image it creates needs to reflect that. So people look at us, they think as, hey, this is the most innovative company, this is the most cutting edge company. Of course, we want to create a trusted element out of it as well. But nobody's going to buy us because they feel that, hey, we are the most trustworthy.
With Gen AI, generative AI coming in and disrupting a lot of industries, do you think it will have an impact on fintech as well? And if yes, where do you see the impact and how do you envision the next 2-3 years with generative AI in fintech?
So I think generative AI is again a very broad-based technology. I'm sure it will be applied to every segment. Definitely will be applied to fintech. And the reason for that is like, again, it's a very fundamental shift in technology, the way tools are available to us, the way web was a change in the way things are delivered. I think Gen AI changes the way a lot of problems are solved at scale. We are taking a lot of lead on that. We have did like at least 10-15 projects running on generative AI right now, which we are planning to announce in the next couple of months. And some of the areas that we have already started implementing Gen AI, for example, we started doing it for KYC verification. Most part of KYC verification we solved through OCR, but there are challenges in India is there's so many documents where OCR doesn't work. For example, for businesses, one of the basic tools that we need to collect is Shop Establishment Act. Now, every city, every state has their own Shop Establishment Act certificate. Like every city decides what format they want, and even then, in the same city, every 2 years it changes. So you can't have OCR functionality work for that. Now, generative AI, when we implemented it, reduced the time for onboarding by almost 85-90% for this verification, because like nobody had to open it. The tool was able to extract specific information from that document that our teams need to review. So they only review that information once it comes out, and it speeds up the process far more quickly than it would. That's one example. The other example is on cross-border fraud. We handle a lot of cross-border volumes, and fraud in domestic side is solved a lot through OTP, but cross-border fraud is still very high. And there again, generative AI plays an important role in seeing the pattern of customer behavior. How quickly has he shopped through? Has he moved through the checkout page? How quickly has he clicked on pay? How quickly did he fill up all of his form fields and submit? All of those things are very hard to do through, like, of course, the normal neural networks also solve through that. But generative AI takes it a notch further, where it gives you the entire outcome. The normal neural network can take these fields and signals and process it based on what you tell them. But generative AI allows you to process it based on what other users are doing. So you can see what every other user is doing, and then something stands out as an anomaly. It can filter that out and tell you that this person behaved something differently than what everyone else did. And then your team can review it and reduce fraud.
Harshil, when you were getting rejected by 99 bankers because you lack experience, what kept you going forward on this idea, and what stopped you from pivoting to another idea where you have experience?
Yeah. So I think there are two parts of building when we started building payments, and maybe a lot of it was our ignorance, but when we were building out, we didn't know how complicated this bank part would be. So we started building the product, we started talking to customers, and then we started parallelly the bank conversation. While the bank conversation was taking its own time, we hit a great success on the consumer and the product side. We were able to build a really good product, and when we spoke to customers, they really loved the product that we were building. I think those two things gave us a lot of confidence that while the bank part is a problem, we need one yes there and we are sorted. Like we need one banker who had to say yes, and that's it. We don't have to sell to 99 banks. We need just one bank to say yes. But on this side, the customers are liking us, and this is where we need PMF. This is our true product market fit. So as long as these customers like us, whenever we get that yes from a bank, we'll be able to go out and sell to all of these customers. So there's some progress happening constantly, where we were constantly going out and talking to the customers, and every new customer we met said, hey, yes, like somebody made a comment here, hey, we hate whatever we are using today, and we want to try something else. Like this really looks amazing. Can can you bring it out quickly? So almost every customer we spoke to, especially in the early stage, said that to us. So that constantly gave us the confidence that the need is there, and the challenge that we are facing, right, like are big. And of course, it's not that we didn't ever sit down and said, hey, is this the right space to build for us? And what we did was we set ourselves a timeline. Then in the next 3-6, I think we set a timeline of 4 months. If next 4 months we are not able to solve this problem, then we'll have to move out, because there's no other way we can keep building in this space.
Hi. Sorry, I mean, I hope. Okay. First of all, Harshil, thanks so much for this. And I know both of us are a part of a WhatsApp group, and by far the most easy and approachable founder to reach. Reaches, I mean, I've personally pinged him for small queries and he's gotten back. On a more serious note, one of the things that you mentioned is that your values have been consistent for the last 10 years. When you guys were 24-year-old founders, what process did you follow or identify within yourselves that you were able to identify these values which have stayed consistent? And the related part to this question is, as your company scaled, you obviously became the face of the company, got more media limelight, so on and so forth. How do you prevent egos to come in the co-founder relationship?
Well, that's a very good question, and I think that it's a very hard problem to solve that founders need to solve very early on. I'll start with the first part of the question, right, on the values part. So honestly, when you're starting the company, there are no values defined. You don't write down these 4 values. Even if you write down, they make no sense. You're a 10 people company, 15 people company, the values are what you say and do. So in the early days, there was no defined values per se. It was what the founders did or the early team did and said. I think that kept getting imbibed whenever new folks would come in, right? Because it's a very small core, like you're 10, 15 people, you're working in the trenches, you're working day and night. What you say and do or what decisions you take is what everyone else replicates, right? So the values part comes in when you start hitting like 50, 60 employees, where everybody cannot speak to the founders or the early group, and people need some guiding principles. So the way values get implemented changes at every course of company. At 60, 70 employees is the first time we wrote down, these are the 5 values that we have. And that values we didn't just pick up from the air, hey, honesty sounds good, so let's put it there. But it's more like, okay, what do we actually say and do? What do we actually believe in? And what are we actually practicing? So for example, transparency was a practice that we had from day one, but we said, hey, this is something that we want to continue. So we wrote that down. And similarly, like we wrote down like challenge status quo. Because as a company, our ethos was we were challenging the status quo in the ecosystem. So that's something that's a value that needs to flow in. So similarly, like there are 3 or 4 values that we set up in the early days. And at 50, 60 people, we started writing them down. Now at 100, 200 people, then they changed. Just writing those values was not enough. Because somebody said transparency and said, hey, why can't I see everyone's salary? Right? So how is transparency not applied here? So then we have to define what does that value mean, right? So when we said customer first, they said, hey, my customer is asking for free, can I give it for free? Because that's customer first. So you need to start defining those values. What does this value mean in terms of 1 line or 2 line statements? And similarly, at 500,000 employees, again, that changes. Just 1 line is not enough. You need to have a proper handbook of sort where people can go through specific examples that they'll face day to day and how to take that decision based on values. So the way the values are implemented, and sometimes the way the values are implemented also change and morph over time as the organization scales, but the core tenets remain the same. So that's what I meant by the values remain the same, is that the core tenets remain the same. The way the values are implemented and the way they are talked about, some nuances around them that we also hadn't thought when we set up the values. Okay, does transparency mean everything is visible internally, or what does that mean? We also had to start defining those as the organization scaled up. The second part of the question is far more harder on how do you handle egos, right? And that happens to even the best of founders, right? One of the things is that, like, I think between 2 founders, typically I've seen that one founder gets most limelight because you take the CEO role, and by default the ecosystem pushes you towards a higher limelight role. So you need to find out, like, between the 2 founders, like who is that gonna be? And while it sounds like an exciting opportunity that, hey, everyone will look at me, it also comes with a lot of responsibility, right? So, and sometimes you need to ask that hard question that do you want to take that one? The other important aspect is that as the organization scales up, it is important that even though the media is going to put somebody on the pedestal, within the group, that doesn't come out. So if you've defined, for example, that one person is a final decision maker on vision and product, like for example we had, that Shashank is going to be final decision maker, that needs to stay true. It can't be that, hey, because I have this pedestal and I have this limelight, I am the final decision maker, and because I'll have to go out and say it in public. Internally, that shouldn't happen. The third thing is that, like, because one person is always going to be highlighted more by the ecosystem, you need to be very take a lot of specific actions and be very deliberate about giving other founders enough of an opportunity, enough of a space to feel that hey, they are not getting completely overshadowed by one person. And that has happened to a lot of even the largest of companies in India, where one founder has gotten so overshadowed over time that they had to step out of the company, right? And that is the hardest thing to do. And the only way it happens is that the one founder who's getting the limelight or getting the public visibility takes deliberate actions to ensure that the other founder also gets the limelight. Okay, push them to more events, even then you are invited to every event, push them to some events, push them to some media conversations, push them out to take some public discussions, at least within the company, give them the space to have more broader discussions within the company. If you're spending a lot of time externally, then give somebody else the internal spotlight. So you have to take a lot of those deliberate calls to ensure that the other founders in the organization don't feel overshadowed completely by what the public is going to push one founder towards.
Hi, thanks for spending time with us, first of all. So legal and financial regulation, these are the two frameworks where people, the starting up itself is a blocker. So what were your steps considering you guys came from a non-finance or a non-such background? What were your steps to kind of decipher all of this and then start building Razorpay?
Yeah, so it's harder, especially when we come from a tech product mindset, like both of us did. We didn't really understand regulation very well. Even if we did, we don't understand the logic for regulation at times, which is still hard, right? So sometimes you say, hey, this sounds illogical. Why do you have OTP? Like, why does everyone need to type OTP? And there's a proper logic in that. Like, if you look at like most regulations in India, there's a proper logic. Like, India as a country needs OTP, right? Because like even with OTP, people fall to so many frauds. If we didn't have OTP, it wouldn't work. We are not like US. We don't have proper legal recourse available. So you need OTP to prevent fraud versus US methodology where fraud happens. So if you look back, these regulations are thought through. The first important aspect is to realize what regulations are. Regulations are like market forces. So don't try to, there's no point of judging or questioning them. Right? So there's no point, like you can't say, hey, why India is a poorer country, why US is a richer country. You can't change that. So there's no point of blaming it. Similarly, regulations are what they are. They are thought through for a specific reason, which it's very hard for you when you're starting up to understand what their reasons are. But you can take it as market forces that they exist. Now, how do you build around it? Right? And so like you study market forces, it's important to study regulation. So when we're building and talking to bankers, we spend a lot of time reading through all the regulations, reading through every regulation, going through each. And I myself and Shashank themselves went down and read through these regulations to understand what are they expecting of us and how can we comply with it, but still create a different experience than what everyone else has built. Right? So as I said, like the easiest example is to treat it like market, the way you treat market. You spend a lot of time researching the market, you spend a lot of time talking to people in the market, you spend a lot of time figuring out how to navigate the market and create the experience that you want to build or create the company you want to build with those market forces existing. Treat the regulations the same way and speak to regulator or in early days it's hard to speak to regulators, speak to people who understand regulators, speak to people who have spoken to them, try to understand what is the gist of things and then build your product experience around that, like within that framework so that you meet that framework but at the same time are able to deliver the great experience that you want to go out and give.
So follow-up question around how you were prioritizing based on customer commits for B2B. How are you thinking about, especially when you're pre-product market fit, how are you thinking about prioritizing things that were necessary for being enterprise grade versus things that you needed to do to be best in breed?
Yeah. So as I said, like the only way to do that is like having dedicated bandwidth towards like long-term things that you want to build, irrespective of the customers are asking for, right? So like I gave an example of self-serve onboarding, the kind of processes that you want to follow on the developer side and stuff like that. These are things that we knew that would create long-term mode for us because we'll build an organic base that nobody else has, but that will require us to sacrifice some bandwidth away from enterprise. So you have to dedicate that bandwidth away. Now, the percentage depends, every company is different. For us, we get about 30% of our bandwidth specifically towards long-term projects. And we continue to do that even on product prioritization today, that 30% of our bandwidth is dedicated towards long-term projects, things that we're going to do even when no one is asking for it right now. But 60-70% of bandwidth was dedicated towards things that people were asking for us. And again, these percentages might change for different companies, but the outcome is same.
So were you putting the enterprise grade things into the long-term things, or was those things that people were asking for?
Enterprise grade, I think if you mean by things like reliability and stuff, that falls on the 30%. Because those are things that typically don't ask as features. Those are things that you need to do to ensure that your platform reaches a benchmark. By enterprise, things that we were building for them were more like features that, hey, can you build this feature? So that will mostly be in the 70% category.
Okay, we're sorry, we're done for the day. And first of all, thank you, Harshil. You've been extremely kind with your time. Big round of thanks. I think it's not just the clarity that came out in terms of the way you answered some of these questions, the passion, the ability to actually inspire for your own team is extremely evident as to where it comes from. And I'm sure I've interacted only once with Shashank. I think it's phenomenally similar for him also. It's very clear why Razorpay is an institution today, and really best wishes for you to, beyond all financial hurdles, really build this to be one of the biggest institutions. Thank you again for being with us. I have one last question. Who is Harshil beyond work? Like, what do is there something, if you had to give a tip on either physical or mental health and or productivity, because a lot of people here also come from different backgrounds. Is there something that's worked for you personally, professionally?
Yeah, see, work takes most of the time, so you don't have a lot of time, honestly. I think a couple of things that I've done to create like mental peace for myself is that having very strict boundaries now on things that are like completely like at certain point. Of course, something urgent happens, you always have to be available, you're always on call. But like, for example, Sundays are completely always when I work like for 5 days a week. Saturdays generally for meeting founders and meeting other startups that I'm going to invest in, or meeting other founders that I want to connect with from a general perspective, or things that overflow from the 5 days. And 6 days, like the 7 days, Sundays typically separated, that don't do any work conversations, don't ping me, don't call me unless it's extremely urgent and I need it on call. So that separation is important. At some point of time, you cannot work 24/7, so you need to have some separation, especially even in evenings like 8 p.m. later. Typically, I have a separation that don't ping me unless it's critical, but mostly don't ping me. Sometimes things get stretched, but 9 p.m. is a hard stop, and Sunday is a clear hard stop. The other thing is that like having some pastimes, having a circle of people that are like that you can be completely open up with, like that you can completely like don't have to think twice, don't have to think a lot. Having that group of friends is really important. It's easy to say, most people have that, but it's very hard for founders to maintain that, because once you go into that build phase, you don't have a lot of time for those people. So, and then you can't suddenly like spend 2 years just building, and then out of 2 years suddenly say, now I have time, now can I spend time with you, right? Like you need to keep building that out even when you are like in the full struggle phase. And of course, generally your good friends will understand that you're in struggle phase, so you can't give too much time, but you need to give it some little bit of time constantly, because it's important, especially when you go through these questions of like struggles and pains and all that you need something to take your mind off. And that circle becomes your place where you can be yourself and you can completely stop thinking about the challenges of every day and just go out and either talk or discuss or do something that you like.
Thank you so much.